all of you. I, Dr. Sanjiv Pattnaik, I welcome all of you to this particular session, that is understanding risk, return and volatility. This particular unit that we shall be going through in this particular session is a part of MMPF 007, that is equity markets. In the block 1, Introduction to Financial Markets, the unit 1 covered the basics of the financial markets. So in the last session of the unit 1, we had seen the various financial system components, the various markets and how they are operating. So today we shall be looking at how a general person in an economy tries to invest his money. When I say any person, that means anyone having surplus returns. Now, what is surplus return? Suppose my income is 100 rupees per month. I spend on all my requirements rupees 80. My family needs, my household expenses, my other expenses, repayment of debt, etc. I spend 80 rupees. So the remaining amount of 20 rupees, now I shall hold it in my hand or I shall put it somewhere. If I hold it in my hand, well, we can do it. But will it grow? The answer is no. We may be having the liquid cash or the cash in our pockets, but it will not have the incremental effect, or it will not increase. However, if I put that money, that 20 rupees, instead of spending today in certain avenues, suppose bank fixed deposit for 1 year, definitely all of us know that the fixed deposit will give us some extra amount over the 20 rupees that I have kept as fixed deposit. That amount which I am getting over and above the 20 rupees that I have invested in the bank fixed deposit is my return. Now, we also have two other terms in this particular unit, that is risk and volatility. As we move on, we shall be looking at the risk, the return, volatility. And today also we shall see how mathematically we can calculate them. Let us go into the study. When I try to introduce the risk, return, volatility, let us think about today's economy. Today's economy, if we look around, most of the biggest companies in the world are IT companies, the information technology driven companies. Think of anything that will be driven by the IT. Automation. Now, automation is the buzzword. The human labor is being done away with. Automation helps to do the things precisely and in such a way that there is no tardiness or fatigueness, as it happens in case of human beings. Today we look at the faster trading and settlement. We can do one thing. If we want to put a fixed deposit immediately, almost all people have smartphones. We can go to the online site of any bank and immediately we can have a fixed deposit over there through electronic transfer of fund. Similarly, if we are investing in certain companies through either equities or debt instruments like debentures, etc., then that also is done immediately through electronic payments. And the settlement process, that means that I am giving my money to a certain organization, is done also at a very fast pace. Now we are looking at globalization. The whole world has or is becoming a single place to trade. So any organization to survive must have the competitive edge. And now the trade has become free trade. Mostly all countries, they are opening up their borders, so that what will happen, the quality and the cost, efficiency and effectiveness will be ushered in that particular economy. However, there is increased risk for market participants. What is the risk here? Now there are two words that go hand by hand. We have uncertainty. We also sometimes tell that uncertainty is risk. Now, let me try to tell what is the basic difference between the two. Suppose today morning when I am starting for my office and it is a rainy season, suppose the chances are there that it may rain because it is rainy season. Also, if it doesn't rain, that chances are also there. So two kind of things are happening here. It may rain, it may not rain. Now we are not certain about it, whether it will rain or not rain. We cannot say up to 100% accuracy that it will rain today. What we can say? Up to certain extent, suppose 90% extent, that it will rain today. What it means? That maximum chances are there that it may rain today. But still 10% chances are there that it may not rain today. I have suppose forgotten my raincoat and I am going by a bike to my office. And it is the rainy season, 90% chances of rainfall is there. I have forgotten my raincoat. So if it rains, then I will be drenched and may get ill. So this is the outcome of the uncertainty that creates some kind of damages or losses to me. But if it doesn't rain, the remaining 10%, what happens? That these are the good things that may also happen to me. So risk is the outcome from an uncertain event that creates bad things or damages or losses to the person concerned. So risk is the risk is what we can say is the uncertainty of getting damages. Now global changes have impacted the Indian economy. How? Think about gold prices. The gold prices in India in recent times has seen an upward surge. Why it has happened? Because the gold prices in the London trading has also surged upwards. So we are impacted by a global factor. Whatever gold prices happens in London exchange, that impacts the Indian gold trade. Similarly, think about the IT companies. Most of the big IT companies, either they are from India or maximum Indians are being recruited in those companies. And they have offices in the United States. Suppose United States closes its door to IT companies of other countries' origin. immediately it will impact the Indian IT sector because the maximum clients are there in the US market. So any kind of global changes will or are having an impact on the Indian economy. So it is for the authorities, the regulatories, or the government to show the direction how these changes have minimal negative impact on the Indian economy. Now let us get into what is risk and what is return. Uh, just now I gave an example of uncertainty and how risk is different from uncertainty. We can say risk is the losses or damages that may happen out of outcomes from an uncertain event. So that portion, the risk, always is borne by the person concerned or the investor. We shall see how we can calculate risk. Along with that, what is the return? That also I said through an example. Suppose I am investing a certain amount in a bank fixed deposit for a certain period of time. After a period of suppose 1 year, I get my principal back. That means the invested amount. Along with that, I also get some extra amount in form of interest. That interest is the return. What is the return? The reward for investment. Now, why a person requires a reward for investment? First of all, we can say that we are postponing our today's consumption to a later date. Instead of spending my amount that is left after meeting my requirements, I keep it in some kind of or some form of investment. So that requires to be compensated. Now, when we are talking of return, there can be two type of returns. One is nominal return, another is real rate of return. Now, what is nominal return? Now, the return that we find on pen and paper or on the documents that we have in front of us. But is it actually the return I am getting? The answer is no. The return is affected by a certain term called as inflation. That means our returns will be eroded to some extent by the inflation part. So when we adjust for inflation, we call the nominal return as real rate of return. We have taken an example here and we shall try to solve it. Suppose an investment of rupees 100 grows to rupees 125 in 1 year. I have invested 100 rupees. After 1 year, I am getting 125 rupees. So, principal amount is 100. Excess amount or the extra amount I am getting for parting with my money for 1 year is 25 rupees. So, what is the nominal return here? First, let us check for nominal return. So, nominal return is equal to how much I am getting? 125 divided by the invested amount minus 1, that is equal to the first portion becomes 1.25 minus 1, that is 0.25. It is the same thing as 25%. So that means on my investment, I am getting a return of nominal return of 25%. However, when we go to the second line, there we find the impact of inflation. Suppose the inflation rate during the period was 7%. So how much is it actually I am getting a return of 25% on my investment? The answer is no. It has to be adjusted for inflation to get the real rate. So here it is 25% is the real rate, and when you are discounting the impact of inflation rate, so I am getting a return of 18%. The nominal return or the return that I think was 25%, but actually that is coming to me as a power of 18% return because it has been adjusted for inflation. Now, what are the components of investment or the returns? We have three components. Let us check for the three components of returns. First is returns due to stock selection. This has been derived from Eugene Fama's framework for performance attribution. Now let us see how it is being done. We have taken an example here, a portfolio. What is a portfolio? A combination of securities, that means two or more securities, is called as a portfolio. Has offered a return of 18% during a period. When the market index, now what is that market index? Now let us see. When we are telling market, that means it takes into account all the companies, all the industries, all the producers, be it goods or services, into account. It is very difficult to gather data and calculate the market returns. So what we do, we take a substitute for that in form of market index. In India, we have two best substitutes, that is Bombay Stock Exchange Sensex or sensitivity index of Bombay Stock Exchange, and the Nifty of National Stock Exchange. Whatever are the returns of those, we consider that to be the reflection of market index. So the market index during the period reported a return of 8%. During the period, risk-free rate of return is 6%. Now, what is risk-free rate of return? Suppose I invest in a bank fixed deposit. I will be getting, suppose, 8%. Any bank. Is it always guaranteed? Yes, maybe 99.99% of the times SBI will guarantee you that you will get back your principal amount and the fixed deposit return. However, is there a possibility of not getting your amount back? Yes, 0.01% chances are there. Maybe due to unforeseen events which may occur in the future, the banks may not be or will not be able to repay you back the invested amount. So, think about a security issued by the Government of India or Reserve Bank of India. They have the power to uh, print or decide how much money is required in the economy, and they try to circulate that much money in the economy. So the securities given by RBI or the Government of India, they face the least chances of getting defaults in paying back the principal amount or the interest amount. In any economy, the government bonds, etc., they are having the least default record unless until some unforeseen thing happens. So here we can tell that the risk-free rate of return is what the government is giving on its securities, and in our question it is 6%. Now the risk measurement we shall be calculating later on. The standard deviation of market index and the portfolio are 12% and 9%. Beta of the portfolio is 0.80. Now what I understand by beta of the portfolio? Now the portfolio I have created, the market changes, the market return changes. Accordingly, the change is happening due to changes in the return of the securities that comprise the market index. So, how much change is occurring in the securities return as compared to the changes in the market return, that is shown or given by beta of the portfolio. Suppose beta of portfolio is 0.80. This is positive 0.80. What we mean by that? That if the market return or the index return, market index return increases by 1%, then the security, the portfolio's return will increase by 0.8%. And also vice versa. If market return falls by 1%, then the securities return will fall by 0.8%. So beta is the sensitivity of the portfolio return as compared to the market return. Now let us see what is the expected return for the portfolio as per the CAPM, Capital Asset Pricing Model. Now here I will be calculating the expected return as per CAPM. I represent it as expected return Now let me substitute the things. RF stands for the risk-free rate of return. That means RF. Beta of the portfolio is given directly. Return of the market index. And again RF which we have taken. Now what is the expected return when I put the values? Now I will calculate it, or you can calculate it by taking the values. It turns out to be 7 The expected return on the portfolio was 7.6%. But how much the portfolio has given a return? Now it is 18%. So the fund has given you an 18% return. You see here, we expected 7.6% on the portfolio as return, but it is giving us 18%. Now, the difference, (10.4%) is the ability of this excess return we are getting due to the ability of the fund by the fund manager in stock selection. So the more able the fund manager is, the more returns, excess return he can generate, he or she can generate. Now the second component is the risk taking factor. Now for the risk taking, how much is the return I am getting? Now here, normal return for the portfolio due to risk we can calculate as is equal to RF plus RM minus RF, that is market return into RF, divided by sigma stands for standard deviation of portfolio divided by standard deviation of market. So when I substitute the values, I get it as 6 plus 7.50%. Now, our normal return was expected to be 7.50%. What is the expected return? In the previous slide we had seen, expected return was, looking at the previous slide, it was 7.6%. So as compared to the normal return for the risk, I am expecting a return of 7.6%. That means an differential of 0.1% extra I need for risk in order to calculate the risk excess, how much I require. Now it is 0.1%. Now the third component of investment performance, that is the return, is market timing. We have fund managers who are knowledgeable enough, experienced enough, and they know when to invest in a certain avenue, that means whether equity or debt, or to come out of the particular avenue. So usually the market timing is pick up high beta stock when the market is in upswing. That means when the market return is increasing, go for stocks in your portfolio which have higher betas, because they will try to give you more and more returns. If the case is otherwise, market is falling and you have high beta stocks in your portfolio, you may suffer huge losses. So move out of stocks during market downfall and move into the debt instruments. Now, risk return trade off, when we are talking of, we take into account the human psychology. Higher the risk we are having, higher is the expected return. More the risk we take, the more the return we want. In other words, the risk premium. In real world, we have three type of persons. That means risk appetite of persons are this kind. First is risk averse. This kind of persons, they do not want to take unnecessary risk. Even if a slightest higher amount of risk is given to them, they will require a proportionately higher amount of return. That means they are risk avoiders. Second are certain category of people are there who love to take risk. They are risk takers or risk lovers, because they know that when they are taking risk, it may be compensated with higher amount of returns. And another category is there, they do not have any kind of feelings towards risk. They only think about return this much. Yes, all right. What is the risk? They are least concerned. So we call them as risk neutral persons. So in real world, we will find these three type of risk takers. Now, when we are talking of risk, what are the types of risk? We generally categorize the risk into two types: systematic risk and unsystematic risk. Let me give an example. Uh, the interest rate in Indian economy is decided by the central authority or the Reserve Bank of India through their various interest rates fixation. Now, once the interest rate is fixed, then each and every bank, financial institutions, they try to give loans over and above that fixed amount of interest rate. That means whichever organization wants to take loans, etc., from the banks, they will be affected by the risk, by the return, interest rate that is fixed by Reserve Bank of India. Now, what RBI does, if it wants to flush the economy with more amount of money in circulation, they will decrease the interest rate. What happens? The banks will give you cheaper loans and people will readily take money and go for certain kind of growth, we can say growth sectors they can set up or invest in their own businesses. Suppose RBI finds inflation is going upwards, that means huge amount of money is there in circulation in the economy, which is not required. So they will try to increase the interest rate. Thereby, what will happen? The loans will become costly. People will not try to take loans but will try to make deposits. So, When I talk about interest rate in Indian economy, it is affecting each and everybody at the same time in the same way. So the system is getting affected as a whole. We do not have a control. We cannot change the interest rates. So it is uncontrollable. It affects all the economy. So it is broad and it is external to us. If I am a corporate, it is not in my hands. It is external to my operations. Some of the systematic risk are economic risk in the economy, political risk and sociological risk. There are certain other components of risk which do not affect each and everybody at the same time or in the same way. That is called as not from the system or unsystematic risk. Industry risk. Suppose the iron industry, we can say. If the iron industry is facing a slump, it doesn't mean that the garment industry will also be having a slump. That means coming downwards. It may be going upwards. So industry to industry, the growths and the declines may be different. So we call it as unsystematic risk. It is not affecting all in the economy in the same way. Financing risk. Now suppose a company, it requires certain amount of money, 100 crores. It has options either to go for equities or bonds or a mixture of the two. If equities are 70, it will be getting 30 crores from bonds. Similarly, another company similar to this company may be having 50 crores from equities and another 50 from bonds. So the financing pattern will be differing from company to company, and that also affects the overall profitability of the organization. Market. The marketability of my corporate's products may not be same as marketability of another corporates producing the same type of products in the economy. So market for a particular brand's or company's product may be differing from each other. Credit risk. Now suppose we have given our goods on credit basis to certain persons. They have to repay us back. Is it always that the repayment is same for all the companies? No. Some company may be having better recovery of their credit amounts as compared to some other companies. The companies which cannot recover their credit amounts given to the persons either through goods or services may suffer losses. Similarly, we have also operational and liquidity as a part of unsystematic risk. Now, how can I measure risk? Now, here we have two type of things. Either we can have the historical data taken into account to calculate the return and risk, or we can take the future anticipated returns in order to calculate the return and risk. Now the risk is measured through the statistical technique that is called as standard deviation, represented as sigma. Sometimes people also say variance. Variance is nothing but standard deviation square. Now I have taken an example where past 3 years data are given, return percentages are given 10, 18 and 8. We shall proceed to calculate what is the return and what is the risk when past data or historical data is given to us. Now what is the total return I am getting for the 3 periods? Now if I add all the thing, that is 36. So the expected return R, when I put a bar above that, that is expected return, and these are the individual returns. R bar is equal to 36 by 3, that is equal to 12. What we mean by that? The expected return is the simple arithmetical average of all the returns. I add all the returns and divide it by number of items, that is 3. So expected return I have got from the historical data. Now I will proceed to calculate the standard deviation. Now first I will calculate deviation. Now what is that deviation? Deviation is nothing but difference between, when we say difference, there are two things at least. The difference between Ri minus R bar, and let me denote it as D. So first one, let us check 10 minus 12, that is minus 2. Similarly, 18 minus 12 is plus 6. 8 minus 12 is minus 4. In the last step, I will calculate the square of the deviations, d square values. So minus 2 square is equal to 4, 36, 16. Now when I take the summation, I get the value as 56. Now the variance or sigma square, that is equal to variance, that is equal to summation of d square divided by n minus 1, that is equal to summation of d square is 56 we have got, n is number of items, that is 3, number of periods minus 1, so overall I get it as 28. Now we require standard deviation, sigma is equal to root over sigma square, that is equal to root over of 28. That gives me a figure of 9.17%. So the risk of the particular security is 9.17%. Similarly, you can have other measures like Sharpe, Trainer and Jensen's differential measure. Apart from that, you can go on to calculate the return and risk from the expected data, that means the future data. When we are talking of future, we talk of probability. So here we can complete this. Suppose it is Pi probability and this is Ri. So first I will calculate Pi Ri, then Ri minus expected return, then I will calculate the D, this is D, then D square I can calculate, then I will calculate Pi into D square. If I calculate all the things, the standard deviation sigma is equal to Pi D square summation. If you put the values, you will get it as 3.46. And if you want to calculate the expected return, ER, it is simply the summation of Pi Ri that will turn out to be 14%. We can fill the table and we can get the things. And we can diversify the risk either by investing in physical assets, land, building, gold, silver, etc., or financial asset like stocks, bonds, etc. So with this, we'll be concluding.